In this video, I'm going to review Shopify. So for those of you who are an investor in Shopify, stock is down 80%. I know this is a little nerve-wracking, but hopefully this video will give you a little peace of mind on what's going to be happening with this stock in the near future. So we're going to do a forum analysis. We'll start with Tykr to look at the margin of safety. That's the math part of investing. Then we'll jump over to the meaning, moat, and management. Let's dive in. All right, when you go to Shopify within Tykr, you can see the stock is on sale. That's a great sign. We see a score of 10 out of 20 and then a margin of safety of 80%. Share price is 385 and sticker price or fair value is about 1900. So good signs there. The financials, we would like to see a little higher. Of course, the 10 out of 20 is the bare minimum. On sale on Tykr is a 10 or higher and a 50% margin of safety or higher. So we're just meeting the minimum, but let's take a closer look at the financials and really see what's going on here. So when we get to the annual statements, we're going to take a look at the income statement, cash flow statement, and balance sheet real quick. You don't have to do this, but we do present this data if you're interested. Unfortunately, Tykr does the hard work for us and rolls it up into that score and that margin of safety. So looking at the revenue year over year, looks fantastic. Really nice increase year over year, just really impressive. What's even more impressive is the net income and the EPS, which are pretty similar metrics. So EPS is the net income divided by outstanding shares. That's the most important metric that investors and institutions look at with businesses. But either way, you can see a year ago, the net income was about 319 million. Well, it's jumped up to 2.9 billion. That's a great sign there. So of course, with the EPS, we see that nice bump as well. Now, if we go down to the cash flow statement, we can see the free cash has increased nicely over the last 2 years. And then the balance sheet, we can see it's like picture perfect, textbook. Assets just increasing year over year. Same thing with your equity. The liabilities and debts are increasing. We ideally like to see those two data points decreasing. And we'll get into that in a little bit. This is related to some acquisitions and a more recent acquisition that was quite expensive, but it should work out in the end. The issue with the stock, the financials at least, is when you flip it to the quarterly here, you can see the revenue is a little flat. Net income has declined, and of course, your EPS has declined. So Tykr, what we do is we look at about 5 years, approximately 5 years. We try to go that far. Some stocks won't have that much data available. So we like to go at least 3 quarters, but we look at the quarterly statements and then we run the math that way. Again, we do it all for you, but I'm just giving you a little context here and this works. So in this case, this is why this stock score isn't a little higher. This is part of the reason is the net income and EPS, they are kind of falling back. We want to pay close attention to this. I'll talk about this later in the video. Let's do the same here with the free cash flow. We'll go quarterly. Looks really good a quarter ago, but the most recent quarter, you can see we've gone back into the negative again. So another point to pay attention to. Again, this is why that score isn't a little higher. And let's do the same here with the balance sheet. So looking at assets, if we just go back in time a little bit, increase quarter over quarter has been a little flat the last few quarters, maybe a slight decline, which is okay. Liabilities, little increase as well, but it's pretty much level. Debt is level, and then equity is level as well. So the balance sheet is actually pretty good. The risk from the financial standpoint is the income statement and cash flow statement. So overall with the financials, I think we can check that box. Looking pretty good. We do want to see a little bit higher score as the stock goes the next few earnings reports, but overall looking pretty good. So let's jump over to the meaning of the business. This is where I spend a lot of time is what does the business do? How do they make money? How does it look? How does this business look over the next 10 years or so? So what I'll do is I'm going to reference a few news sources here in a second. But starting with the first question is, how does Shopify make money? So Shopify first launched as a straight SaaS platform, and then it introduced soon after the transaction fee model. So I'm a big fan of SaaS, love the recurring revenue, whether it's month over month or year over year, both on the B2C, which in this case, Shopify is business to business, B2B, but 20% of revenue is from subscriptions, that SaaS model, and 72% is from the transactions. And that can include some products here, including you've got Shopify Pay, which is kind of like its own payment processor, like a PayPal or Square. You've got, or I should say Stripe. Then you've got currency conversion, shipping. There's a point of sale hardware product that is competitive to Square. And then they have Shopify Capital. So it's kind of like a bank. You can borrow funds from the business. Of course, there's an interest rate you're going to pay like any bank. Great business model. So I'm really happy to see that within Shopify. And then you can customize features, I think, for additional price as well. But that's 72% of revenue is from the actual transaction fees, not the SaaS. That tells you something about the business model of creating a transaction fee model. I'm a big fan of this. I like SaaS a lot. Two business models I consider superior would be your transaction fee model, and then of course advertising, the model you see with like Google or Facebook. So let's jump into the news a little bit. So for those of you who do hold the stock or you're waiting on the sidelines to get into the stock, we have some pretty exciting news with Shopify. So first off, this relates to the higher liabilities and debts. So Shopify has been known to make a few acquisitions over the years. What I like to do is kind of write in these articles. You can go to Tykr.com and go to our stock reviews and see this full article. But I like to give a little context on the history of the business. And they have acquired a lot of businesses. This is a smart play because typically in big business, you will see a buy before builds model. Or there's a philosophy within, I've worked for some organizations that use this, is you should be buying other businesses instead of building your own. It's much faster to go to market. It's a lot less risk. There's a lot less bugs. And when you have competition, you want to get there first. So buy before build is hot. They do that. In this case, they're buying what looks like it's a company called Deliver for $2.1 billion in cash and stock. And what this software does is it helps with like predictive analytics, smart model, anything that I'll tell you right now, anything I see that's around logistics or supply chain, pretty boring industries, but there's a lot of room for improvement. So I think that's a great place to be for Shopify acquiring this business. 2.1 billion though, that's a little bit of a hit to the debt there as well as the liabilities. So you're going to bring in a lot more payroll, a lot more employees. So nature of the business when you're acquiring another company. One thing to keep in mind is with a software business, you're not going to see a lot of like high overhead with of course, like manufacturing equipment or materials because it's software. But this will get you thinking about some of the businesses that you invest in that have like a physical product, think like an auto manufacturer like Tesla. You've got a lot of metals and plastics and aluminums. Those come at a cost. And how do you get those products to your manufacturing plants? There's supply chain. There's a lot of overhead with those types of models. Software, of course, I love because you don't have those elements to the business. Anyway, moving on. Another article here from Seeking Alpha. This was a really fun title, which I can agree with. This is a broken stock, not a broken company. So the stock is down 80% from its all-time high. But has the business really become that weak? The answer is absolutely not. And they do speak to that because as we saw with the financials, that year over year revenue continues to increase. It's really a solid business model. They're doing a great job there. Something else fun here from Motley Fool talked about Buy with Prime is a new feature that Amazon is introducing where other e-commerce platforms outside of the Amazon network can use this to buy products. You can buy with Prime right there on that site. Now, there's a little bit of risk. Some analysts were talking about, hey, this is a risk to Shopify. Amazon is going to take business away. Well, what the CEO of Shopify said, Tobias Lutke, he mentioned they're going to introduce the buy with Prime on Shopify sites. So if says here, the requirement is you need to be an Amazon FBA seller, fulfillment by Amazon. If you are that classification, you can add that buy with Prime right there on your platform. In my opinion, I think this is a great opportunity. You're working with a bigger business, not against them. I'm a big fan of that. And in this case, I think both Amazon and Shopify are going to see an increase in revenue, increase in traffic. I think that's a great play there. And I do agree with Tobias saying this is a win. This is something we're excited to introduce. All right, this is the big news. So as of the recording of this video, it is June 28th. Shopify will introduce a 10-to-1 stock split on June 29th. So by the time this video is live on YouTube, that split will already have occurred. The stock, of course, in the whole market is really down right now. So it's not like the stock is going to take off right away. So don't feel like you're missing out on any opportunity here. But stock splits are really hot, especially for B2B business. But when you look back at history, like I think Microsoft conducted like 9 stock splits since the 80s. And then Apple, I think it was 5 or 6. And with each of those, because they're well-known brands, you typically see a lot more activity from retail investors. A stock split, of course, it's not going to, in this case, make us 10 times richer with a stock. What it does is it cuts that share price down and just makes it a lower barrier to entry. It's a lot easier for people to get into. You think like the Amazons and the Googles of the world, pretty expensive stocks from a share price standpoint. You know, when you're paying over $1,000 for one share, you know, your motivation to get into it is a lot less, especially for a lot of new investors. Well, what we have here, if the share price is I think, what did I say? It's $3.85. So essentially it's going to be $38.50 is what we're looking at, which is amazing opportunity. So if you're going to do a stock split, you want to do the split during a down market. It's that 1-2 punch. You give the opportunity for a lot of people to get into this stock. And when the market rallies and turns around, stocks like this can really take off like a rocket, especially if those quarterly reports are exceeding expectations. I'll touch on that in a little bit, but that's what we're looking for. I'll give you like my play-by-play what I would do here. But with the stock split, I think that's amazing news. So something to keep in mind here. Again, video is probably going to be live after this split has occurred. Next up here, this was really fun. So CNBC was talking about how e-commerce sales has declined about 1.8% from a year ago. And there's a lot of people getting worried, like, oh my gosh, all these people are going to flood the retail market. We're going back to stores. Brick and mortar is going to be a thing again. No. Okay, so the horse and buggy is going to be a thing again, and we're going back to using coal. So I'm just kidding, but in this case, yeah, Shopify's taking a hit. So Shopify, Etsy, Wayfair, there's a few other businesses that are in the e-commerce space. Sure, they've taken a hit in this case, but e-commerce is always going to be the play. So to give you some examples here, I have some friends that work in the retail space, and they're talking about how customers will actually walk into stores if they do go to a physical store, and they're checking out the prices of whether it's electronics or hardware or clothing, and they're doing their shopping in person, but they're price shopping on their phone. And in many cases, they're making the purchase right there on their phone from another company. This shows you that e-commerce, this is not going away. So if you ever feared that, wow, okay, Shopify, I'm really afraid here, I want to sell, it's down, I don't think it's going to recover. In that regard, e-commerce, it's not going away, trust me in this case. So yes, a little scary with the stock being down 80%, but there's a lot of stocks down at that level. PayPal in my portfolio is one of those. But in this case, I think you're going to be okay with e-commerce in the future. One more comment I want to make here with Investors Place did list 7 hot stocks to start buying right now. Top of the list, Shopify. This list also includes Roku, Alibaba, Upstart, Twilio, Disney, and Adobe. So overall, the news really positive on this stock, where e-commerce is going. hold strong if you're an investor. We're going to keep going here, but up until this point, you've got the margin of safety, you got the meaning, both look great. Let's move on to the moat. Third M. So Amazon, we can look at as a competitor. Sure, you can sell products on there. It could pull some customers away, but I really like the fact that Amazon and Shopify, they can work together a little bit. So that's great. It's better to work with your competitors than against them. A few other sites I want to list. You've got Wix, which is public, a website builder. They do have an e-commerce bolt-on, but they do not have big brands, kind of like what Shopify does, and we'll touch on that in a second. You've got BigCommerce as another site. Now, two other sites or platforms I'll talk about. You've got Salesforce, which sure, there's maybe mid-sized businesses, but there's large businesses that will use it for e-commerce. Great product there. And then you've got Adobe. So I've got some experience with AEM, it's called Adobe Experience Manager. And that product, that's not for small or mid-sized businesses. That's for big businesses. That's what they use to build their sites. The sticker price on using that product for like a large brand with thousands of SKUs can be, just for using the platform, it can be hundreds of thousands of dollars on up to millions of dollars a year just for the SaaS. That's the SaaS price. So whole nother level. Shopify's enterprise play does compete with that a little bit. I would have to really get in and see the bells and whistles, but I don't think it's going to be as robust as AEM, but it's still a really solid product. Shopify, we're going to jump to the pricing here. They've got basic. You've got your Shopify mid-ground. Basic is $29, Shopify is $79, and then you got your advanced, which is $299. Pretty easy prices to get into. Of course, the bigger your business, and let's touch on some of those right now, the more you're going to pay. And then, of course, there's a transaction fees. That's where Shopify is making the majority of its money is off those fees. So going back up, just to list some of the customers that are on Shopify, this includes some impressive brands on the list. So Netflix has like a shopping cart of some sort where you can buy physical products, but then you've got Penguin Books, Staples, Gymshark, LA Lakers, Fitbit, and more. The larger your business is, in other words, the more SKUs you have, more products, that means more configurations. In this case, trying to move to another shopping cart is really hard to do. And that's what makes shopping cart sites really sticky. A lot of big businesses are going to commit to an e-commerce platform. They're not going to try it for like a week or a month, which you see with a lot of these small business owners. They'll try this e-commerce platform for a month or two, then they'll switch to this. Well, they don't have the number of SKUs. They don't have everything set up in this case. So Shopify or any other large shopping carts, they're going to be a little stickier. There's another company I do want to address. This is Dukhan. Dukhan is based out of India. You can see their pricing starts at about $10 a month, then up to $50. So a lot cheaper than Shopify. Now, what it sounds like, you can build a site. They claim you can build an e-commerce site in 30 seconds or less or something like that. That's great. This is going to be great for that small business market. A lot of e-commerce people out there who it's just them. Maybe they have got 1, 2, 5, maybe 10 employees. They're going to go with this. And sure, they can take some of that SaaS market share away from Shopify. But I'll tell you right now, based on my homework, this is not a robust platform like Shopify. The customizations, the other apps it's connected with, it's not a competitor in that enterprise space, those bigger businesses. They do advertise the enterprise plan here, but I did some homework. I could not find any larger brands. Maybe there are a few, not aware. So I don't see Dukhan as a threat, although this is all the hype around the internet right now. Based on my experience working for larger companies, especially in e-commerce, I don't see them taking away the enterprise business. We'll see. It's very hard to get somebody to shift to a very competitive product. It's just a huge amount of effort. It can take 6 months, 12 months, a year longer. And that's a very painful and expensive process. So I don't see the threat here, but keep it on your radar at least. So looking at the moat in this case, sure, there are a few competitors in the space we can pay attention to. It's probably one of the weaker parts of the business. E-commerce is hot. There's a lot of tools out there. I still think most of these businesses can thrive, Amazon especially. I'm looking at Salesforce. I think they do more than just e-commerce. I mean, it's a CRM tool and more. They can do a lot. So that's why I think that stock will be fine in the future. Adobe, I'm a big fan of that business. I think they'll be fine as well. So Shopify can thrive in this market, and I think it will see some nice jumps in the share price here when the market improves. Let's touch on the last M. So we got the management. So Tobias Lutke, he founded the company, and he's a younger guy for a CEO of a public company perspective. But he made a recent comment on Twitter that said, "Is there a place where financial analysts' track records are kept? People seem to pay attention to them, but are they being held accountable for what they say?" Great question. So there's a lot of analysts that talk and talk and talk. Some are right, some are wrong, whatever. The issue in the statement is he's spending his time worrying about what people are saying about the share price. And I do see that with some younger CEOs as they do get caught up in Twitter and Reddit, and they start worrying about what people are saying. And I did make a reference here. He should take some notes from more senior CEOs that I really respect, one being Satya Nadella, Microsoft, the other being Lisa Su, AMD. You will never see those two CEOs complaining about analysts or worrying about their share price. They're hyper-focused on their product and where their company is going. They're very good at that. So Tobias, I would say turn your attention more there. I think you're already there, but stay off Twitter, maybe stay off Reddit as well, or wherever you're getting your feedback. But you will see that with younger CEOs. So he's got a little more room to grow. Overall, I do think he's doing a good job with the company. I do like the buy before build strategy a lot. They've made quite a few acquisitions of other companies. It's a smart play. You can go to market a lot faster. So you look at the 4Ms overall, financials looking pretty good. Could see some improvements there. Business model, outstanding. The moat, I think it's competitive at least. There are competitors to pay attention to, but most of them can thrive. And management, I think Tobias is doing a pretty good job. So here's what I would do. We have the stock split, which of course probably already occurred when this video goes live. Then we have an earnings report. I think the next one is coming up in July. What I would do is let's see what happens here. The stock's not going to take off overnight. The market's really beat down right now. It's not going to rally. So it's not going to run into a FOMO situation here. But in this case, I would pay close attention. Hopefully we see that EPS. We have our expectations and then we have our reported. And we want to see that reported coming higher than expectations. That's a great sign. So with the stock splits and that expectations being beat, I think that's a good trigger point to say, hey, let's get into this stock right now. Now, jumping back to another video I talked about, how long will this bear market last? People are talking about we kind of transition from a bear market to recession. I'm starting to hear that. Doesn't matter what you call it, market's way down. I feel most tech stocks, especially those that are 80% down, probably aren't going to go down too much more. PayPal, again, I mentioned, I hold that stock. Is it going to go down a little further? I really don't think so. I think a few other stocks that are in the tech space could. And then I do believe S&P, so your non-tech stocks, now we could see a little more decline there. The rally could start happening this fall. If it takes a little longer, that's fine. We're going to be well prepared. Just make sure stocks like this, when those good reports come out, stock is on sale, and you got good news all around, keep buying more. This is the time when you methodically buy more. Just don't take the whole chunk of change you got there in your account and throw it in all at once. What you want to do is methodically keep buying more every week. That way, if the stock keeps falling, you're getting those lower price points. Hopefully this video helped. If you have any other stocks you want me to take a look at, please leave a comment below. We'll see you in the next video.